Now, a common choice most investors will have to face at one point or another is whether they should take all the money they have available and put it to work in the stock market, or spread it out over time as they see fit, or as we say, dollar cost averaging. This is an age-old dilemma that has plagued investors since the dawn of time, but fear not, there is a definite answer to this question. Welcome back to another video. Today we're having a look at lump sum versus dollar cost averaging. So please tune out all the noise about crazy market prediction, market movements. Like the video, share, subscribe if you enjoy it, drop me comments if you have any questions, and let's get right to it. Now, the usual scenario here is our little investor friend over here coming into a lump sum of money through inheritance, bonus, a sale, or a side job going well, and wondering whether he or she should stick to their monthly contribution plan to their stock portfolio or put it all to work at once. Now, fear not, whether you invest in ETFs, index funds, mutual funds, or individual stocks, the answer is the same, and it is a definite one. Now, the reason why we're in doubt over this dilemma is a battle of the brain halves, where an analytical part is telling you to put it all into the market because you never know what's going to happen, right? So why try to time the market? And the emotional one telling you to be a little bit careful and take it slow. And of course, you should always take into consideration your situation when you're making investment decision. So how much money you have, where you want to invest it, and when you want to invest it, and your life situation in general should be taken into account. But that said, here is the tough truth. You see, no one, absolutely no one, knows what the stock market is going to do tomorrow, next week, or next month. Whether it'll go up, down, sideways, or in a circle. But what we can do is have a look at statistics, and the statistics tells us that most of the time, just about 2/3 of the time, the stock market goes up. So since 1930, the S&P 500 has had 61 good years and 29 bad years, or years in the red. So because of this, you should assume that tomorrow the stock market will most likely go up, meaning lump sum is off to a pretty good start. But fear not, dollar cost averaging is not giving up just yet. Because what if the stock market is at a raging all-time high and seemingly at the end of a bull run? Should I still put all my money to work at once? I'm afraid the answer is still yes. You see, lump sum has beaten dollar cost average in every and any period we have statistics on. And this chart from Y Charts shows LS beating DCA 77% of all months from 1997 to 2018. And it's not even close. And when they pulled the chart back to 1960, it still came out with lump sum beating dollar cost average, albeit only 73% at the time. And this article and I myself could go all day on with charts from different time periods and across different asset classes. But the answer is the same. Dollar cost average is statistically debunked. Now, one of the most common arguments for employing a dollar cost averaging strategy is high prices or PE ratios, insinuating that whoever's talking thinks that prices will fall in the short term. But this brings us to sort of a gambler's fallacy sort of thinking. Just because prices went up yesterday doesn't increase the chance of prices going down today. Just like as if you roll a dice and it hits 5 3 times in a row, the chance is not any less for the next throw to also be a 5. Now, the correlation will be stronger in the stock market because prices can't fall forever. So if they keep going up, they will fall at some point, but you have no way of timing this. So don't fool yourself with this implied probabilistic correlation that isn't even there. But it's quite difficult explaining this to someone when it's very easy to come up with a perfectly fine sounding argument for dollar cost averaging. I'll give you one example here, but notice how it all hinges on me in one way or another predicting the future. So, I'll just start buying when prices starts falling, bringing my average cost per share down and hence my return. I don't want to get burned at these really high prices, and the upside potential is decreasing by the day as prices go up. I can stay in cash for a while, no problem. Now, this brings us to the danger of trying to time the market, because it is, as you guessed, impossible. And the danger is missing out on the famous 50 best trading days during a year. You see, most of the return you make in the stock market is made in the 50 best trading days of the year. The rest is actually pretty much goes sideways. And you make most of the money even in the best 5 days of the year. And Fidelity actually had a look at this. So a funny example for you, believe this. If you had $10,000 in 1980, they did an experiment where they look at the difference between investing those $10,000 in one lump sum on January 1st, 1980 versus spreading it out over the whole year of 1980. And up until 2010 or 2020, if you just missed the 5 days, the 5 best trading days of 1980, it would cost you $250,000 in return over 30 years. And so a huge percentage is gone if you miss out on those few golden days. Now, of course, guys, in extreme cases where prices of a company, let's say Tesla or whatever, has surged hundreds of percent in weeks or months, I would stay on the side of caution. But those sorts of investments are not the ones most people have. Most people are invested in ETFs, index funds, or big blue chip stocks. And in that case, dollar cost averaging shouldn't even be in your vocabulary. Now, an alternative to dollar cost averaging is just gradually building into a position. Simply put, you buy some now and you buy some later. You might want to think about the company more, assess the situation, do some more research, wait for a product launch or earnings reports. However, I wouldn't even recommend this approach, as you should be supremely confident in a company before you invest. But an approach like this does make more sense than waiting for the sky to fall down and prices to fall. So I think it's okay to build onto a position, but you should keep buying even if the price doesn't fall. Now, with all this said, guys, I know that most of you do dollar cost averaging in a responsible way and with good intentions. And you're not just sitting around waiting for the sky to fall down. And you're most likely simply building onto a position. I've been guilty of this in the past and I will in the future. But I try to keep these irrational emotions and strategies out of investing, and I try to simply stay at least 90% invested, if not 100%. I keep some cash laying around for other stuff as well. So stay cold and calculated come bear or bull market. And the best thing to do is usually nothing at all. Time in the market beats timing the market. Hope you learned something. Let me know your thoughts on this issue. I know there's going to be some people for or against. Hope you enjoyed the video. And most importantly, that I'll see you in my next one. See you.